Not only did JP Morgan cover over almost 800 contracts at the bottom, but even more interesting was what we saw with SLV. With SLV, we saw 38 million ounces of silver delivered at the bottom into SLV. But if you look at the way that the prospectus reads, it says that there might be a lag between share issuance and metal coming in.
Mm-hmm.
So they buy it at 100, or they sell the shares at 100, and then the minute it hits the bottom, oh, here's your 38 million ounces that we sold $30 ago. So the games that have been playing have allowed, in my mind, and not only that, the metal is taken from the open market and delivered to SLV warehouses. And who controls the SLV warehouses but the big commercial banks, who can then drain metal, which we see it all the time through what's called share redemption. You can drain metal out of SLV without anyone seeing it. A couple weeks before Christmas, it might have been $15,000, $16,000 for us to hedge a 5,000-ounce silver contract. We normally have 2 million ounces in our warehouse. So if you can hedge 5,000 ounces for $15,000, if you have several $1 million in a margin account, you can have a $2 million a 2 million ounce inventory hedged ounce for ounce. But then they moved it up to 18,000 right before Christmas, 21,000 the day after Christmas. Now it's just under 50,000 to hedge 5,000 ounces. If you don't have $50 million in your margin account, good luck. And so not only has it made it very expensive to hedge, this is what has gummed up the refineries. This is what has made it very expensive for companies like mine and even a notch above the primary distributors to hedge, because it's become so expensive to hedge. But when that happened, they did this to flush out the speculation on COMEX. If you have 100 contracts and you say, look, silver's going straight up, we can take advantage of this. We can do so by buying a bunch of contracts, right? $15,000 back then would allow you to control, in essence, 5,000 ounces at $60 right around Christmas. That's 300,000 worth of silver. Let's do it. Let's buy 20 contracts. They are choking on silver, but they can't hedge it. And it takes time to go from here, which it has to be broken down, melted, turned into shot, and then refined into bars and rounds. It takes a long time. But the price had been moving up so fast, along with the margin increases, they were getting margin called before they even broke down the silver. And like, what do? We keep getting margin called. We're not making any money. It takes time to refine this stuff. We have to stop taking new business. That's what they did. When I look at the things that have made me successful, there's been about a half a dozen really big deals that I've done with my client base, and they've all centered around one commonality: identification and exploitation of price anomalies. This is an anomaly. So I'm going to get in trouble for doing this, but I don't care. I own the company. So I'm just going to say 99 cents back a spot while supplies last, because I bought as much as I could. And maybe I'm stupid to have done so. I said to my traders, buy it, hedge it. I don't care. Just leave it there.
Andy says 15 million ounces of silver vanished from COMEX vaults. Gold has 13 tons still open with 4 days left. CME hiked margins to 50,000 to crush specs while big money bought the bottom. JP Morgan covered 800 contracts and SLV added 38 million ounces at the low. The US is building a secret silver reserve, and junk silver is under spot for the first time ever.
This is what I've been screaming. And this is all that matters. If a 500-ounce mint box weighs 42 pounds, who just took possession and left the warehouse for almost, over 38 million ounces? Think about that for a moment, about the logistics that is involved in it. Now, I think it's the Exchange Stabilization Fund. Like I've been saying, for 16 straight months, we've seen these kind of deliveries and withdrawals for 16 straight months. Not one person in the mainstream asking this. All they talk about is the price and the BS fundamentals where they paint negatively. Never do they say, you know, Johnny, forget about all that. I want to know who the hell's standing for delivery. Where's it going? This never happens. This is all that matters. And the lack of journalistic integrity, the one half truth, but missing the whole story. And do you think, Adam, that there's any coincidence that after all of these months of delivery and all of these months of metal being pulled off the exchange, just by coincidence, it's now critical mineral? We're going to call it critical. And we're going to put a state-sponsored price floor under it. And you know what? Just for good measure, we're going to accumulate a strategic stockpile. So all I can simply say to you, now that's February. Let's talk March for one moment.
Okay, real quick, because I want you to answer this in your continued answer.
COMEX silver shock. What JP Morgan and BRICS may be doing behind the scenes something unusual is happening in the global silver market right now. And according to precious metals analyst Andy Schectman, the clues are pointing to a quiet but massive shift happening behind the scenes, involving major banks, global exchanges, and possibly even governments. Because when you start putting the pieces together, the numbers don't look normal. Let's start with one of the most surprising developments.
Where is this all going? Like if it's leaving a BRICS vault, which I believe COMEX is, but you tell me if I'm wrong there, but if it's leaving, a big secure vault, where do you put all that stuff? Do you put it in another BRICS vault, or is this, in your interpretation, going under, into a government bunker underneath a mountain somewhere?
I would say that the legit companies like, let's say Tesla, they'd leave it in the BRICS vault or move it to, in certain points, to the manufacturing facility where they make the cars and the batteries. But if I'm the Exchange Stabilization Fund, it's going, I don't know, is there a vault under the White House? Who knows? Who knows where? Is there a vault under the Pentagon? Who knows? And that's a fair question. I mean, how?
Well, there just aren't that many places you can store this much silver other than in a professional BRICS vault, or if you're a government, your secret bunker layer. Yeah.
Well, and what's 38 million times 80? What is that? 238 million ounces times 80 in terms of dollar value is what? What would that be? I
think it's 2,400, whatever, if you're multiplying 80.
Well, let me just, I can't even do
or
do
38
the math
by 80. But yeah, here, I'll do it. You talk. I'll
38,082,934 times 80, let's just call it. So remember, we would go back and forth and say, and I would have said to you, Adam, listen, I got to cover this short. Don't worry. These are one-way tariffs. He's crazy. This will blow over. We're going to send the metal back. Don't worry. Just like we always have for the last 50 years. Ain't coming back. They reshort it. They hoodwinked them, They hoodwinked them into sending the metal back to reshore. It wasn't about tariffs. It wasn't about arbitrage. That was the ruse to reshore. And now that metal is just leaving the vault and getting it out of the way. JP Morgan, not too long ago, took a whole bunch of metal that was registered and moved it outside to a completely different category, which is outside the entire COMEX ecosystem, still on their balance sheet, but is no longer deliverable. So there are games being played by those in the United States, I think, to get on sides, leaving those exposed. The systemic nature of it, if Luongo is right, can bring down some of the biggest banks in Europe. We already saw what TD Bank tried to do a few weeks ago. They said, we think silver's going to $40. We're putting a huge short position on it. Bang, they get stopped out at 92. And I've done a lot of research on it, and I want to comment about one thing, and that's the premium in Shanghai. With the $10 premium above the Western price, people commented and said, well, what about the VAT tax that offsets it? It's not true. So the VAT tax that is added in China is the responsibility of the recipient of the metal after said recipient takes the metal off of the Shanghai exchange. So think about that for one moment. That $10 premium right now, or thereabouts, that they're paying over the Western prices, arbitrage that is sucking all the silver over, where a sophisticated trader sends $20 million at a $10 premium, makes $200 million and buys yachts in Tahiti. That VAT tax is in addition to a cost for the recipient. In addition to that $10, 13, 14% they're paying above and beyond when the metal leaves the Shanghai exchange. It is not the responsibility of me, the sender. It is me, the recipient, when I pull that metal off the exchange. So just a little point of clarity. I promised everyone I would make sure about that, and I am sure about that now. So that VAT tax, in essence, saying to China is saying, we want your silver so bad, not only will we pay you a premium to the Western price to siphon it and arbitrage it over, which isn't ending, right? Normally arbitrages end right away because the metal or the money or the investment goes to where the arbitrage is and it balances out. Here it's not. They're saying leave it on, and you'll be responsible for the VAT tax when you move it out of the exchange. That goes to show what the real price is and how badly they want it, and you know, just how screwy the Western paper price is. But in terms of why, I mean, think about it. What it basically says is we're choking on dollars. This is a byproduct of this huge trade surplus. And we realize that dollars have the lasting power of a melting ice cube. So let's take as many dollars as we can and find ways to find value for those dollars. And if it means paying a premium above the Western price, which we, the Chinese, believe is BS, then let's just pay more for it. Doesn't matter. That's the same mentality they've used for my entire career, Adam, when they have been mining gold that all analysts were saying was non-economical, that it was costing them $600 to pull gold out of the ground when it was priced at 400, 1,000 when it was priced at 700, 2,000 when it was, I mean, so they're digging deeper, going further. What do they care? This is the thing that is important to understand. If their plan is a long and to use the Western price against us. And I think that's exactly what we're seeing right now is the Western price that I think price discovery is shifting eastward. It's leaving London. It's leaving New York. And as long as Western paper stays disconnected to Shanghai, physical silver will keep getting pulled out of the West and sent to where it is really valued. And the scary part is even Shanghai is getting tight with premiums moving out. And I think that's why forwards and futures are starting to feel undeliverable, where market makers can't source the metal easy enough. They can't hedge cleanly enough. And their exit becomes the move, where, in other words, the players here in the United States, it looks like they are exiting their positions. Central banks were selling, but then you had the Bundesbank, after 3 years of saying, give us back our gold, get really vocal about it, give us back our gold. But then we saw the Dutch bank, Hungary, Austria, Turkey, Poland, Czech, all of these banks said, give us back our gold too. And then in 2018, those same banks bought more gold as a group than they did in the 60 years previously combined. And then in 2019, that number doubled. But just coincidentally, the BIS said, by the way, those of you that own gold, it's now a tier 1 asset. That's how it works, huh? So let's just look at silver for a moment. We see month after 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 month for 16 months, billions of dollars every month, 40 to 70 million ounces every month. No one says who's doing that. That's really weird. And oh, by the way, it's now critical mineral state-sponsored price and price floor. And remember what Judy Shelton has told us both. She just met with Percent, right? What is Trump talking about yesterday? Nonstop, if you watch his speech. How many times did you see July 4th, July 4th, July 4th, July 4th, 250th anniversary? Could it be that he backs the back end of the Treasury market with gold, with the Genius Act on the front end? Maybe. We'll find out. It's held by the issuer, period. This is done to keep the banks from losing all of their deposits. If the stablecoin market could give interest, everyone would pull their money out of the banks. Just like that, they'd all collapse. And they would go to private issuers. So, okay, fine. So you look at, like, for example, Tether, USA Tether, the primary benefactor of the stablecoin market issuing what the Genius Act says in January of next year or sooner, but that's the latest. When money moves, it will move via stablecoin. You'll never send a check again. You'll never send a wire again, ever. They're gone. It's like Venmo or Zelle. When the stablecoin is created, I'm going to send you $1,000, Adam. Stablecoin is created. The rails are the blockchain. The stablecoin is the car. Okay, I owe you $1,000. Attached to it is a short-term treasury, 90 days or less. That is not transferable. Whoever creates a stablecoin keeps it. When it gets to you, you take your $1,000, the stablecoin is blown up. Now you look at your bank, nothing's changed, just the instant money movement, right? Yep. So the interest isn't transferable. What are they doing with the interest? Look at what Tether has already done. They are the largest holder of gold in the world outside of central banks. They have almost 15 billion in gold. They're taking the interest and they're buying gold. Now, Bo Hines was Trump's crypto czar till August. He's now the CEO of USA Tether, which is already Genius Act compliant. Do you think there was a wink, wink, nod, nod? You're going to buy gold with all of that interest. This is my thought. Now, here's a supposition. You buy gold with all of that interest. that gold is going to funnel its way back to, at some point, the Treasury Department under the Exchange Stabilization Act. We will pay you for it. You'll be rich beyond your wildest dreams forever. But here's the point. In order to devalue gold, to his point, to a level sufficient enough, it's not devaluing it against the Dixie, it's letting gold go to the moon. And as every time money is transferred, whether you buy a pack of cigarettes or a new villa, I don't care where, and I don't care, all of the people that will create them, whether it be Visa or Bank of America or American Express, they will all be backed by 90-day or less short-term treasuries. Synthetic demand to keep the front end of the curve down.
Right.
But the interest isn't transferable. It goes to the issuer who, if they continue to buy gold at this level, not only do they push the price of gold sky high, remember what Judy said, back the back end of the treasury. I want to cover that for 1 second. I know we've gone over that a million times, but there's another little twist. But it also devalues the dollar, right? So we can do to the rest of the world what they've done to us, devalue our dollars so that we can.
At the recent price, bottom in silver, reports indicate that JP Morgan closed more than 800 silver futures contracts. That alone is significant. Large banks typically manage positions carefully. And when a move like that happens, right at a market low, it suggests that big money may have been positioning for a reversal. But that wasn't the only thing happening at the bottom at almost the same moment. 38 million ounces of silver were delivered into the SLV ETF, one of the largest silver investment vehicles in the world. Now, think about that number for a moment. 30-8 million ounces is not a small adjustment. That is an enormous physical delivery. And according to Schectman, the mechanics of the ETF system may allow metal to move in ways that most investors never see, because the SLV prospectus states that there can be a delay between the issuance of ETF shares and the arrival of physical silver in the vaults. In other words, shares can be created first, the metal can be delivered later. Critics say that structure allows large institutions to manage physical supply in the background, potentially influencing price movements in the process. But the ETF activity isn't the only strange development. Another major signal is, coming from the COMEX vault system, Schectman says that about 15 million ounces of silver recently disappeared from COMEX vault inventories, and this isn't an isolated event. Over the last 16 months, the exchange has seen enormous physical movement, with estimates suggesting between 40 and 70 million ounces of silver being delivered or withdrawn every single month. That means billions of dollars worth of silver has been moving through the COMEX system. Yet one question remains almost completely ignored in man's financial coverage. Who is actually taking delivery of all this metal? Because storing this much silver is not simple, and that brings us to another important development that may be affecting the market. The CME recently raised margin requirements for silver contracts dramatically just a few months ago. Hedging a 5,000 down silver contract required roughly $15,000 in margin today. That same hedge can require close to $50,000. That is more than a threefold increase. Higher margin requirements make it much harder for smaller traders and speculators to participate in the futures market. Schectman believes this move may have been designed to force speculative players out of the market, leaving only the largest institutions capable of operating at scale. And while this was happening in the West, something else was happening in the East. Silver prices on the Shanghai Exchange have been trading at a significant premium, roughly $10 higher than Western prices. But this time, the premium has persisted, which suggests strong physical demand in Asia that continues to pull silver out of Western markets. In fact, according to Schectman, this persistent premium may indicate that true price discovery in silver is slowly shifting from New York and London toward Asia. And if that trend continues, it could fundamentally reshape how the global silver price is determined. At the same time, policymakers in the United States started discussing silver as a potential critical strategic mineral if that classification becomes official. It could allow governments to support supply chains, or even build strategic silver stockpiles. Some analysts believe this could be part of a much larger economic shift. The silver market is showing signs of unusual stress, with massive deliveries, rising margins, strong Asian demand, and physical metal leaving Western exchanges. And if those trends continue, the global silver market may be heading toward a very different future. The biggest question now is simple: where's all the silver going? Because the answer to that question could determine the next major move in the precious metals market.